Today's episode is brought to you by Mazars.
SoundCartel.
How much could your business benefit from a multi-million-dollar cash investment in return for a minority share? That's entirely possible, thanks to a new growth capital fund which is backed by government. You just need to meet the criteria. From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Anthony Healy is the CEO and MD for the Australian Business Growth Fund, a public-private partnership between the government and major banks. In this episode, he outlines what businesses need to do to qualify and prepare for a big injection of cash. He starts by explaining to Jeff Waters what growth capital is and how it differs from venture capital.
Well, first of all, there are some similarities between growth capital and venture capital. They're both providing long-term equity funding that can be up to 10 years, and they're typically, in both cases, minority shareholders. But where it's different is VC is an earlier stage type of investment where the business has just started out. It might have not even a customer base to start with. It's got a product that it's developing, it's looking for a market, or it's trying to prove up its customer base, and it's typically pre-profit. So it's a much higher risk investment, but that's balanced by when you're a VC fund, you might take bets on 100 companies, and if a couple really pay off, that's where you get your returns. Growth capital is quite different. We look at businesses with established business models that are on a growth trajectory and want to realise that growth. But the founder, importantly, wants to stay in control of that business through the growth period. So that's why we take a minority shareholding.
But to qualify for the Australian Business Growth Fund, I have to have turnover between $2 million and $100 million. Is that correct?
Yeah, that's right.
So if I find that I do qualify for growth funding, what are the next steps?
Well, the first thing is to ensure that you do meet our mandate. So to your point around the turnover, the stage of your business, the size of capital or cheque that you want us to write. So once we get through that initial qualification, which you can do by applying online through the website where we have an application form, then you'll get a call from one of our investment team and they'll want to discuss your business, understand if it meets the mandate and get a broad feeling for whether the business is one that's going to suit the style of our investment. The second stage from there is you would have deeper and longer conversations with the investment team, which we would largely call commercial due diligence, where we get to understand the business in more detail, the management team, your customer proposition and your market position, and what the growth opportunities are in front of you. What's the use of the capital and what sort of growth can we help you realise through that investment. Once we conclude that commercial due diligence stage, we will have, through that process, also negotiated a term sheet. What are the terms and conditions on which we would invest in your business? We'll agree on that between us, and then we take that information and the terms to our investment committee for the first stage of approval. Once that's approved, then we would undertake the second stage, which is the more formal due diligence where we engage financial, legal and tax, third parties to undertake that due diligence. And that's really about confirming a lot of our assumptions through the commercial stage and proving up our investment case. And at the end of that, and usually during that period, we're negotiating the legal documents that will underpin the shareholder agreement and our investment. And then we move to settlement or to disbursement of the funds to the business.
And what will it mean to my business if I get this huge injection of cash? Won't that be an extraordinary amount of change?
Well, I think, first of all, it helps you to realise that growth opportunity. And in order to realise that growth opportunity, you have to put certain things in place. That'll be either plant and equipment, it might be management, it might be capability. And so, yes, of course, if you want to realise that growth, you're going to be doing new things and taking on new opportunities and challenges. And so that may well require you to bring more management around you and more capability to help you realise that growth. But we're there with you all the way along as a partner. We're helping to guide those decisions. We're supporting you. We're opening up networks and opening doors for you. So, we're there all the way along as a partner to help with those challenges and difficult decisions you have to make.
Terrific. So Am I going to lose control of my business by giving you a huge percentage of it in return for the growth funding?
No, absolutely not. Our mandate's very clear. We are a minority shareholder. That means we can't force decisions on the company. We can't force exits. A lot of what you would call traditional private equity has what they call drag rights, which means if they want to sell, they can drag you through a sale process. We don't have those rights. So we, by definition, rely on our relationship with the entrepreneur or the founder of the business, and we sit alongside them until in the future at some point when they've realised that growth and they then want to perhaps realise the value of their business at that point, then we would all exit together.
Anthony, are there any sorts of businesses that you wouldn't invest in?
Yeah, well, we don't do commercial property. That's the first one. The second is we have a clear ESG policy. So there are some sectors like tobacco, like gaming that we wouldn't invest in. And we don't invest in businesses that have got what's called an APRA financial services licence, because our shareholders, the banks, are in that sector. So we don't invest in those businesses. But other than that, we are sector agnostic and we look at businesses in all types of industries and sectors.
So how's this new scheme been going so far?
Well, I've been personally very pleased with the progress we've made. From a standing start just over a year ago where we had no offices, no staff, I was employee number one. We now have offices in Sydney and Melbourne. We've got a team of over 20 people. And we've made 5 really successful investments in our first year. We've deployed $55 million of capital. And so we've not only from a standing start established the business, but we've been very successful in our investment activity over that first 12 months. And that means more jobs for Australians, more economic growth, more successful entrepreneurial businesses. And so I think I've been really pleased with the progress. And if you look at the pipeline as we look out beyond the first year and into the year we're now just starting, we've got very strong pipeline, which is just reinforcing the fact that this gap really did exist and that there are a lot of businesses around that were looking for minority growth capital for the long term, and we've been able to fill that gap.
That was Anthony Healy, CEO and MD of the Australian Business Growth Fund. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.